Good morning, children. So, today I am going to teach you how to solve the cash flow statement and what are the elements or activities that involves in the cash flow statement. In my theory class, I have already explained you the meaning of the cash flow statement, the concept of the cash flow statement. So, the cash flow statement, the term flow, all of you understand what is cash. Flow here, flow. So, flow means here the inflow of cash or the outflow of cash. That means incoming cash or it may be going cash, outgoing cash. So, either the cash is coming in or cash is going out. When we buy the machinery, cash is going out. When we sell any assets or any goods, cash is coming in. When cash is coming in, it is inflow, and when the cash is going out, it is outflow. So cash flow statement is a statement prepared during the particular year to show the inflow and the outflow of the cash. So it is a statement that shows the inflow, the sources of cash, and the application or the uses of a cash during the particular year. Now that means flow represents either inflow of cash, incoming of cash, or it may be outgoing of the cash. So now when we prepare, when we come to prepare the cash flow statement, so the cash flow preparation of cash flow statement is divided into three activities. So first one is net cash from operating activity. Number two, net cash from investing activity, and number three, net cash from financing activity. So one by one we have to solve. So one by one we have to understand net cash from operating activity, net cash from investing activity, and net cash from financing activity. So among these three activity, the most important or the most little lengthy items, the maximum items that cover the 60% elements, the 60% item of your questions that goes inside the net cash from operating activity. Then comes investing activity, 20% you can say, and 20% goes to the financing activity. So but the majority of the items, the lengthy portion is net cash from operating activity. Once you understand the preparation of net cash from operating activity, so you can easily do the net cash from financing activity, net cash from investing activity. So in my theory class also I have explained you what do you mean by financing activity. Financing activities, so financing activity, the net cash from financing activity, that means here the cash is coming from the issue of shares. When the owner is, suppose for example, let's take example of a furniture house, a furniture company. So when the owner brings the money from as a capital, when capital is increased, the capital incoming of capital in the business, so that is a inflow of fund, that is a financing activity. Capital reduced by the owner, that is a financing activity. When the capital is insufficient, not sufficient, he borrows the loan from the bank, or by the way of if it's company, the owner can take a loan or can loan maybe from the bank or by issuing the debentures. In case of companies, the debenture may be raised. So that is also a kind of borrowing. So it's an inflow of fund when the capital is increasing. So it's an inflow of fund. So that affects the financing activity of the when we prepare the cash flow statement. Again, suppose that again after that whatever capital is accumulated now, whatever capital is inside the business, so that has been utilized for purchasing the machinery, purchase of machinery, new machinery, modernization, expansion of business. So that is cash outflow, that is investing activity. Cash has been utilized for purchase of the assets. So this is a purchase of assets. So sometimes the same asset afterwards it may be old, and the old asset sold, sale of old asset. Also it's the inflow of cash in the investing activities. So this you have to understand it. Sale of asset, purchase of asset is the investing activities. But when the owner of the company, owner of the business, he increased the capital by issuing the shares, by issuing the debentures, by issuing different kind of preferential, or by taking the loan, long-term borrowing. So this is the financing activities. So, but when we come to the cash from operating activity represents the revenue generating from the principal source of the business. For example, as I said, furniture house. A furniture house is increasing the revenue by selling the furniture. He purchased the wood. Wood is the his operating expenses, and he sells that after converting the wood into the furniture. He sells the furniture. Selling the furniture is the operating expenses. So suppose the company has purchased the wood for rupees 50,000, and he converted that in furniture. And after that, when he converted the furniture wood into the furniture, he has so many expenses. So wages paid, salary paid, many expenses are electricity bill, telephone bill, whatever expenses he has incurred. So that is debited to some direct expenses. Are there some indirect expenses? Are there that direct expenses will appear in the trading account? Some indirect expenses will appear in the debit side of profit and loss account. Anyway, afterwards he get a profit. Suppose say his expenses, total expenses, direct expenses and indirect expenses is suppose say 40,000, and he has sold the furniture at rupees 60,000. 20,000 is his cash from operating activity. That 20,000 is his profit. That is his operating profit by purchase and the sale. So what is the principal revenue? That comes under the operating activity. But the same furniture house, if he sells the old newspaper, he receives the interest from the bank. This is also credited to the profit and loss account, but it is non-operating income, so that should be taken out. It is not an operating income. So an operating income the main source of income of a furniture house is to sell the furniture. So that you have to know that the principal source of the revenue of the business is the operating activity. What is the operating activity? Suppose, for example, a sweet shop. Sweets, they produce the sweets. So whatever expenses are incurred in the sweets, and they sell the sweets. So that is the operating activity. To produce the sweets, all the operating expenses are there, and to sell the sweets, that whatever difference between that comes your operating profit. So, but there are so many operating expenses, operating income, but there are so many non-operating expenses, non-operating income that you have to find out. So, but that is because already it is credited to the profit and loss account. So when you prepare the trading account in the debit side, we have direct expenses, credit side we have sales and closing stock. That gives us gross profit. Gross profit is credited to the profit and loss account, and in the debit side of profit and loss account we have so many expenses that are operating expenses also, as well as non-operating expenses also. Operating expenses, non-operating both are there. Some are again non-cash transactions like depreciation are also there. So that does not incur in bad debt or non-cash transactions like depreciations are also debited in the profit and loss account. So that does not affect the flow of cash like depreciation. Depreciation is the expenses. It is a reduce in the value of the asset, but that depreciation is not paid. We do not pay when depreciation is debited to the profit and loss account. That does not mean that we are paid cash on depreciation. It is just a reduction in the value of the asset. That does not incur the outflow of cash. But when we see salary, wages, purchase of goods, rent paid, electricity bill, they are the normal operating business expenses. But there are some non-operating expenses are there. Those are depreciation, bad debt, provision for bad debt, amortization, goodwill written off. That is amortization of goodwill. So they are non-operating expenses. They are non-cash transaction. So they are non-cash transaction, and some are non-operating expenses are also there. Some non-operating expenses may be like interest paid on debenture, interest on long-term borrowing, discount on issue of shares, discount on issue of shares that is written off. So in this way, goodwill, the value of the goodwill has been reduced. They are non-operating expenses, non-operating expenses. But there are also non-cash transactions are there. Non-cash transactions are depreciation. Again, we have bad debt, provision for bad debt. So they are amortization. They are non-cash transactions. So this we have to see. These are non-cash transactions. This non-cash transaction that does not affect the cash, and non-operating expenses are there. Non-operating expenses are there. Non-operating income are there. So inside the inside the net profit, when we calculate the net profit is given by the profit and loss account. Already operating expenses, non-operating expenses, both are debited in the profit and loss account, and non-operating income is also credited in the profit and loss account. That net profit we got, but now from there we have to deduct, we have to take it out. You have to take it out the non-operating income and add back all the non-operating expenses and the cash, the non-cash items. So to find out the net cash, net operating cash that we have to find out. So that's why there is a little lengthy discussion on the when we talk about the net cash from operating activity. So net cash from operating, to find the net cash from operating activity, first of all we have to find out the net profit before tax. Net profit before tax, that we have to find out. So here if you see the net profit before tax, so how to find out net profit before tax? The profit during the year. Profit during the year, if the profit during the year is given, it's okay. You can write the non-profit during the year. But if there is a two capital given, two net profit given, the closing profit minus the opening net profit. In the balance, two balances are given, so net profit is differences in the closing and the opening. That will become your net profit during the year. You have to now add back proposed dividend, interim proposed dividend, current year, interim dividend paid. So this general reserve transfer. So general reserve transfer to the general reserve, transfer to the redemption reserve. These are, by adding this one to the net profit during the year, will get a net profit before tax. So let's first of all we have to find out the net profit before tax here. I'm going to show you how to find out the net cash before tax. So this is one of the element of net cash from operating activity. To compute the net cash from operating activity, first of all we should know net profit before tax. So net profit before tax. So to find out net profit before tax, so first of all, difference in the profit and loss account. Difference in the profit and loss account. That means difference in the profit and loss account can be ascertained by current year profit minus last year profit. If 2 year balances are given, current year balance sheet and last year balance sheet, so current year profit minus last year profit. That means current year minus last year, previous year. Current year profit, that means closing profit minus opening profit. So this way also we can say a current year minus last year or opening year. So that is the difference in the profit and loss. So now we have to add interim dividend paid, proposed dividend. This one is proposed dividend is current year. CY is the current year. Proposed dividend current year. Then provision for taxation. Made during the current year is also current year. Made during the provision for taxation made during the current year. Transfer to general reserve. Transfer to debenture redemption reserve. Or you can also say transfer sinking fund. So these are the items here. Now less income tax. So after adding this one, less income tax refund. So this is the net profit before tax. Net profit before tax. So this is the net profit before tax. Net profit before tax. So in this way, so how to find out net profit before tax? Difference in the profit and loss account, current year minus last year, add interim dividend paid, proposed dividend current year, provision for taxation current year, transfer to general reserve, transfer to debenture redemption reserve, transfer to sinking fund, so transfer to any reserve, so it is to be added back here, and less income tax refund. So in this way, we can find out net profit before tax. After finding the net profit before tax, now we'll find out the operating profit. Now to find out operating profit now, first of all, net profit before tax. Net profit before tax, we have already ascertained before. Now, to find out operating profit, add back non-cash and non-operating expenses. Non-operating expenses. So we have to net profit before tax. To arrive at operating profit, net profit before tax, add back non-cash and non-operating expenses. Those non-cash: depreciation, on fixed asset, depreciation on fixed assets, then amortization of goodwill, or goodwill written off also. Goodwill written off or decrease in the value of goodwill is called amortization of goodwill, that is goodwill written off. Bad debt is to be added, or provision for bad debt, or provision for bad debt, provision for bad and doubtful debt, bad debt, provision for bad debt to be added here. After that, these all are the non-cash transaction. Non-operating expenses are loss on sale of fixed assets, interest on long-term borrowing, those are interest on debentures, interest on long-term loan, they are interest on long-term borrowing. Discount on issue of shares written off, discount on issue of shares written off, preliminary expense written off, preliminary expenses that's written off, then after that less whatever you have to add back here, and less non-operating income, less non-operating income. Those income which are not the principal income of the business, but they are credited to the profit and loss account. Those income are profit on sale of a fixed asset. They are not a principal revenue of the business. So profit or on sale of fixed asset, profit on sale of fixed assets, rent received, dividend received, all they are to be subtracted here. All they are to subtract. Interest received on investment, interest received on investment, minus. So non-operating income are to be subtracted. Those non-operating income are not a principal revenue income of the business, but they are credited to the profit and loss account. Those are to be taken out. So they are to be written off. They are to be subtracted. Profit on sale of fixed asset, profit on sale of fixed asset, rent received, dividend received, interest received on investment. So they are non-operating income. They are to be subtracted. So if we subtract now, we will get here operating profit. This is operating profit. So now in operating profit we have to do now the adjustment of working capital. So after arriving at the operating profit, now we have to adjust the working capital, then we'll come to the net cash from operating activity. Now, dear students, after computing the net cash from operating activity, that's the first part of your cash flow statement. Now the next part is calculation of a computation of net cash from investing activities. The second part, calculation of net cash from investing activity. This is the second part, net cash from investing activity. So this is very easy. As I already said, investing activities are involved in the purchase and sale of the long-term asset, fixed assets, and investment, sale of investment, purchase of investment, and interest on investment received. So here, when the purchase of a fixed asset, the cash is outflow minus. If the sale of asset, inflow of cash is added, and if investment purchase is outflow of cash is going out. So purchase of investment sub minus. So when the investment is sold, sale of investment will inflow of cash will be added, and interest received on investment will be added. So these are the items here. So now purchase of fixed assets. After that, purchase of investment also. Sale of fixed asset. If all assets are sold, this is inflow of cash, so it is to be added, and purchase will be subtracted. Sale of fixed asset. Similarly, sale of investment sale. This is to be inflow of cash. Similarly, interest received, the interest on investment received. Interest on investment. Interest on investment received to be added here. So now these are the items that affect the investing activity finished. It's very simple. Only the investing activity is the inflow and outflow of sale of asset and the purchase of asset and the investment. So So here we got the number 2 item, cash from investing activity. Now after that, third point, number 3, net cash from financing activity. Net cash from financing activity. Net cash from financing activity. Net cash from financing activity are the owners increasing the capital, the shareholders, when the share capital increase added, issue of shares, issue of preference shares, issue of equity shares, when debenture is increased compared to the previous year, raise of debenture, that's long-term borrowing, raise, inflow of cash, all this issue of equity share, issue of preference share, debenture, increased debenture, raised is all the inflow of cash. When the issues are decreased, share capital are decreased, debenture decrease means redemption of debenture, redemption of preference share, redemption of equity share, that will decrease the capital. That will the outflow of cash. So again, interest paid, dividend paid, proposed dividend of last year paid, proposed dividend. So these are dividend paid, these are interim dividend paid, these are the outflow of cash that comes inside the financing activity. So here, issue of equity shares, equity share or preference shares, debentures. So these all are the inflow of cash. When the repayment of redemption of equity share or preference share or redemption of debenture, this is the outflow of cash. The outflow of cash. Dividend paid, proposed dividend paid will outflow of cash. This proposed dividend. If 2 proposed dividend are given current year, you have to add back in non-operating expenses, and last year one you have to dividend, proposed dividend paid. Here dividend paid, interim dividend paid, these are in the financing activity. Interest on debenture paid, here. So in this way, this is the net cash from financing activity. So net cash from financing activity, issue of equity shares, preference shares, issue of debentures, that will be the inflow of cash, redemption of equity share, redemption of preference share. So redemption of debentures is the outflow of cash that's subtracted, dividend paid is subtracted, outflow of cash, interim dividend paid is outflow of cash subtracted, and interest on debenture paid is outflow of cash subtracted. So if we calculate this one here, we'll get the net cash from financing activity now. Now after now we have already all the three activities we have done: operating activity, investing activity, and financing activity. So now after that, to sum up this, now after that, first 1 plus 2 plus 3. 1 is operating activity, second is investing activity, third is our financing activity. If you add all together 1 plus 2, 1 is operating activity, investing activity, and third is financing activity. If you add these three, we'll get a figure, we'll come to one figure. Add cash, opening cash and cash equivalent, cash and cash equivalent opening, cash and cash equivalent. But this is opening last year. Opening. If the sum of 1 plus 2 plus 3, the sum of operating activity, investing activity, and financing activity, if you add opening last year, cash and cash equivalent, that cash equivalent is bank balance, marketable securities. So you have to take as a cash equivalent, which all the current assets cannot be taken as cash equivalent, because here cash equivalent means those which are very near to cash, which are exactly convertible in the cash. Suppose for bank balance is a cash equivalent because you can go to the bank and take out the money. Marketable securities is those securities which you have invested. Whenever you want, you can withdraw the money from there. That is a marketable securities. Maximum time it takes is 3 months, not more than 3 months to withdraw the cash. But debtors is though debtors is a current asset, but when they will pay the money, we cannot say. So in this way, debtors cannot be taken as a market cash and cash equivalent. Bills receivable cannot, because bills receivable has a certain period of time. So that's why we have to wait for a particular period of time. But in this way, cash equivalent, where marketable securities, bank, anytime you can convert into the cash. So they are they are exactly like a cash. So we term it as a cash equivalent. So now if we add this cash and cash opening, last year cash and cash equivalent with the 1 plus 2 plus 3, we will get the figure. This should be matched with the closing cash and cash equivalent. This should be equal with your cash. If your question closing cash and cash equivalent is given, this, if we add this one, this should match with your question, so that you can test the accuracy of at least you will be satisfied. You'll be happy when the result of this cash and cash equivalent will match with your question. That means you will be sure that at least you have solved the problem. You're somewhat like correct. So in this way, we can here test or check the. We can rely on that our solution that it is correct. So this is how we solve the cash flow statement. Only you have seen the first part, net cash from operating activity. Little bit there you have to toil. You have to work hard there. You have to give more time there. Around 60%, 60 to 70%, you can say. 70% you have to give your time and energy in that. Focus on that first part, operating activity, because cash from operating activity has different subheadings also. First, we have to find out the net profit before tax. Then we have to find out the operating profit. Then we have to find out the adjustment of working capital. Then only you can come to the net cash from operating activity. But there is no such division, subdivision, subheadings are there in the investing activity and financing activity. So in this way, first part will be little hard for you, little tough. You have to understand there. But second and third is very, 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 very easy. So you focus on this chapter. It is always one question we are getting in this. So more, I'll solve a question on this. So you have to understand the format. You have to know remember the format also, and we can easily solve this problem. So in my next video, I'll be sending you the solution from this chapter. And thank you. So please work hard. Please study, go through the chapter, go through each and every theory. First of all, you go to the theory part. You have to understand the operating activity, investing activity, and financing activity. Unless and until you do not understand the logic, the meaning of these three-part division of the cash flow statement, you are unable to solve the problem. You cannot solve the problem unless and until you are not familiar with the terms, the theory of this chapter. So if you read the theory properly, understand the theory properly, it will be 50% of your work is done. So go through the theory part. Theory part is also very, very important. So have a good day.